Good morning, everyone. Today we're diving into a place that's often mentioned in the news, movies, and even in everyday conversations, Wall Street. But what exactly is Wall Street? And why does it play such a big role in our lives, even if we've never set foot in New York City? Wall Street might sound exclusive, but it's really just a term for the US stock market. A marketplace where shares of major companies like Apple and Amazon are bought and sold. The name comes from a real street in Lower Manhattan, but its influence stretches far beyond those city blocks. Think of it like a giant farmer's market, but instead of fruits and vegetables, this market trades tiny ownership stakes in businesses, called stocks. Every day, millions of people and institutions come together to buy and sell these shares, hoping to grow their money or support the companies they believe in. Why does this matter to you? The stock market's health is often seen as a report card for the entire US economy. When the market is doing well, it usually means businesses are growing, people are spending, and confidence is high. When companies thrive, stock prices rise, leading to more jobs and innovation. This growth can mean new products, better services, and opportunities for people across the country. Many Americans have retirement savings tied to the market, so its ups and downs directly impact millions. Whether it's a 401k, a pension, or a college fund, the performance of Wall Street can affect your future plans and financial security. Wall Street's movements influence decisions by business leaders and the government, affecting everything from hiring to new projects. When the market signals trouble, companies might slow down hiring or delay expansion, while a booming market can encourage growth and investment. Watching the market is like checking the economy's temperature. It hints at what's ahead for jobs and financial security. Investors, policymakers, and everyday people look to Wall Street for clues about the future. News about Wall Street can move quickly, and its ups and downs are felt around the world. A big change in the market can affect everything from the price of groceries to the interest rates on your loans. It's not just numbers. It's about the money that powers our daily lives. The flow of money through Wall Street helps businesses grow, supports jobs, and even funds public projects through taxes and investments. The companies traded here make the products we use and employ our communities. From the phones in our pockets to the cars we drive, Wall Street helps fuel the innovation behind them. Understanding what moves the market helps us make sense of the world. It can explain why prices rise, why jobs are created or lost, and why some industries boom while others struggle. That's why Wall Street matters to everyone, not just investors. Its impact reaches into our schools, our neighborhoods, and our everyday choices. Whether you're planning for retirement, saving for college, or just trying to make ends meet, the ripple effects of Wall Street are part of your story too. We keep a close eye on it because it shapes our economic future, and understanding it helps us all make smarter decisions for ourselves and our communities. Now, let's take a closer look at what happened on Wall Street this week, where the mood shifted dramatically, and investors were left rethinking their strategies. After a period of steady gains and optimism, the market took a sharp turn, with all three major indexes, the S&P 500, NASDAQ, and Dow Jones, ending Tuesday in the red. This sudden reversal caught many by surprise, especially after weeks of positive momentum. The S&P 500, which tracks 500 of the largest U.S. companies and is often seen as a barometer for the overall health of the market, dropped 0.8%. This decline erased some of the recent gains and signaled growing uncertainty among investors. The Dow Jones Industrial Average, which follows 30 of the most established and influential companies in America, fell even further, down 1.1%. This drop reflected broad-based selling, not just in one sector, but across the board. The NASDAQ, home to many of the world's leading technology giants, slid 1.2%. This was a particularly tough blow for tech stocks, which have been driving much of the market's growth in recent years. The decline suggested that investors are becoming more cautious about the future of the tech sector. The downward trend didn't stop there. As Wednesday approached, futures pointed even lower, hinting at more volatility ahead. The mood on Wall Street shifted from optimism to caution almost overnight. Investors grew increasingly cautious, choosing to move their money into safer assets rather than risk further losses. The fear of more declines led to a noticeable pullback in riskier investments. Even small percentage drops like these represent billions of dollars changing hands in just a matter of hours. The scale of these moves shows just how sensitive the market can be to shifts in sentiment. These market swings reflect the ever-changing moods of investors, who are constantly reacting to breaking news, company earnings reports, and predictions about the future. Every headline and data release can spark a new wave of buying or selling. This week, worry and uncertainty took the driver's seat, especially in the technology sector. Concerns about inflation, interest rates, and global events weighed heavily on investors' minds. The story behind the numbers is what really matters: what investors fear, what they hope for, and how they interpret the latest developments. It's a constant balancing act between risk and reward. When the market stumbles, it's more than just numbers on a screen. It's a sign that confidence is shifting, and that investors are re-evaluating their outlook for the future. This week's declines are a reminder of how quickly sentiment can change, and how important it is to stay informed and adaptable in a fast-moving market. The struggles in the tech sector set the tone for the entire market, showing just how interconnected everything is. As we move forward, all eyes will be on whether this caution continues, or if optimism can make a comeback. What's behind this week's dip? Tech stocks. For months, tech companies soared on AI excitement, but now investors are questioning if those high prices are justified. When stocks double or triple quickly, people wonder if the business can keep up. This week, many big names, Amazon, Microsoft, AMD, fell sharply as investors locked in profits. The pullback is normal after a hot streak. It's a chance for investors to reassess. The big question: is this a brief pause or the start of a bigger correction? Much depends on one company, Nvidia. Its performance could decide if tech's rally continues or cools off. All eyes are on Nvidia's next move. In the midst of the AI boom, one company stands out above all the rest: Nvidia. Once known mainly for powering video games, Nvidia has transformed itself into the undisputed star of the artificial intelligence revolution. Its powerful chips are now the backbone of everything from ChatGPT to the most advanced AI models, fueling breakthroughs in robotics, self-driving cars, and scientific research. This explosive demand has helped make Nvidia one of the world's most valuable companies, with its technology at the heart of the digital future. Nvidia's stock price has soared to record highs, and its performance is now seen as a barometer for the entire tech sector. When Nvidia moves, the rest of the market pays close attention. Investors everywhere are anxiously awaiting Nvidia's quarterly earnings report, knowing it could set the tone for the whole industry. Expectations are sky high. Anything less than spectacular could send shockwaves through the market and disappoint investors who have bet big on AI's future. Even before the report is released, Nvidia's stock has shown signs of volatility, slipping as investors grow nervous about whether the company can keep up its incredible pace. A strong report could reignite confidence in the entire tech sector, sending stocks higher and reassuring those who believe in the AI revolution. But a weak report might trigger a broader sell-off, shaking faith in the market's hottest story. Nvidia's results are more than just numbers. They're a verdict on the whole AI narrative, and a signal of whether the boom can continue or if a slowdown is coming. Right now, the market is holding its breath, waiting for answers. One company's report could move the entire market, shifting billions of dollars in a single moment. That's the power Nvidia holds right now. Its next move could shape the future of technology and finance alike. Beyond company drama, the Federal Reserve is a major market mover. The Fed sets interest rates, affecting everything from mortgages to business loans. Higher rates slow the economy to fight inflation. Lower rates boost growth. Investors are eager for signs the Fed might cut rates soon. This week, everyone's watching the release of the Fed's meeting minutes for clues. Any hint about future rate cuts can swing the market. Recently, hopes for a December rate cut have faded, dropping from over 60% to about 43%. This shift has made investors more nervous. The dream of cheaper money is slipping away, dampening market sentiment. The Fed's next move remains a key source of uncertainty. The Fed's decisions hinge on economic data, especially jobs. Thursday's non-farm payrolls report will show how many jobs were created and how wages are growing. A strong job market is good for workers, but can fuel inflation, making the Fed cautious about cutting rates. If job growth slows, it could signal a cooling economy. Bad news for Main Street, but possibly good for Wall Street, as it might prompt rate cuts. Recent data delays make this jobs report even more critical for the Fed's next decision. Investors are watching closely. The results could set the market's tone for the rest of the year. The jobs number is a crucial clue for what comes next. Tech wasn't the only sector struggling. Retail stocks also took a hit. Retailers reflect the health of the American consumer. Home Depot's disappointing earnings signaled people are spending less on big projects, sending its stock down 6%. This dragged down other retailers like Lowe's and Walmart, as investors worried about a broader slowdown. Consumer spending drives 70% of the U.S. economy, so weakness here is a big concern. The pullback in retail adds to market anxiety. High interest rates may finally be catching up to shoppers. Weak retail results, tech jitters, and Fed uncertainty all contributed to this week's gloomy mood. The American consumer's caution is now in the spotlight. Retail struggles are a warning sign for the broader economy. The stock market is a complex puzzle, shaped by company news, Fed policy, and economic data. This week, tech anxiety, Fed uncertainty, and weak retail results all collided. AI excitement pushed tech stocks up, but now sky-high expectations are causing nerves. Investors are cautious, waiting for Nvidia's report and clues from the Fed. The jobs report will influence the Fed's next move, while retail weakness hints at slowing consumer spending. All these threads are connected, creating a risk-averse mood. The market's direction depends on how these stories unfold. This week shows how quickly sentiment can shift when multiple forces collide. So, what's next? The market's path depends on answers to this week's big questions. Nvidia's earnings on Wednesday could make or break the tech sector. Retail updates from Lowe's and Walmart will reveal if consumers are still spending. The Fed's meeting minutes and Thursday's jobs report will shape expectations for interest rates. Investors hope for a Goldilocks jobs number, not too hot, not too cold. Markets react to news, data, and emotion, rarely moving in a straight line. Staying informed and focused on the long term is key. The coming days will bring crucial information for the market's direction. We'll break it all down for you right here. For now, all eyes are on Nvidia, the Fed, and the American consumer.